Welcome back, everyone, for another deep dive. This time, we're going to be tackling indexed universal life insurance.
IUL.
IUL, that's right. And we're doing this deep dive based on some excerpts from a book that we got.
That makes some pretty bold claims.
Yeah, I mean, the main one we're looking at today is that IUL never loses money because of market declines.
Yeah, that's a big one.
It's a big claim. And of course, we want to see if it holds up, right?
Exactly.
So that's what we're going to be trying to figure out as we go through these excerpts. But of course, we'll also try to break down along the way exactly how IUL works.
I think it's important for people to remember as we go through this that our goal is not to tell you what to think about IUL. It's really just to equip you with the information you need to make your own decisions.
Yeah, good point. So with that in mind, let's get into it. So the author starts off by making a point that really nobody can predict the market's future, whether it's going to go up, down, or just kind of stay flat.
Sideways.
Sideways, yeah.
Yeah.
So that's kind of the first, sets the stage, right?
Right.
And what's interesting is that, at least for the next 10 years, the author seems to be betting on a choppy market. That means lots of ups and downs, but not any clear direction overall.
Right.
So that's the environment they're thinking about. And that's where they seem to think IUL can really
Excel,
yeah. But before we get into all that, I think it's helpful to understand, what even makes IUL different
from traditional investment.
from a traditional investment? So,
Yeah.
I mean, we're all familiar with the idea of investing in the stock market,
Right.
buy stocks, hope their value goes up.
Yeah.
But with IUL, there's this idea of indexing, which basically ties your returns to how a specific market index performs.
Right.
Like the S&P 500, for example.
Like the S&P 500. So it's not directly investing in stocks themselves. It's more, like you said, tracking the performance of the market or a segment of it. And I think a crucial element here is that IUL policies often come with these things called floors and caps.
Oh, yeah.
So the floor is there to guarantee that your account value won't drop below a certain level, even if the market tanks.
Okay, so even if, the S&P 500 takes a nosedive, my IUL won't actually lose value.
Potentially, yeah. It can provide that kind of protection.
Interesting.
And it's important to remember that it's not a free lunch.
Right.
There's a trade-off. That cap I mentioned that limits your potential gains. So if the market skyrockets, your returns might be capped at a certain percentage, even if the index itself grew by, a much larger amount.
So, okay, it's like a buffer against losses, but it also puts a ceiling on how much you can earn.
Exactly.
Okay, that makes sense. I guess that's where understanding your own risk tolerance comes in.
Absolutely. If you're someone who's comfortable with higher risk, shooting for those higher returns,
Yeah.
IUL might not be the best fit. But if you're more focused on capital preservation and steady growth,
Okay.
then it might be something to explore further.
This is all starting to make sense now. So now that we have at least a basic understanding of what makes IUL different, let's go back to this choppy market that the author's predicting.
Right.
So they lay out this hypothetical scenario where the market alternates between a 10% gain one year and a 10% loss the next year.
Right.
For 10 years.
Right.
And this is where it seems that this whole floor and cap structure of IUL really comes into play, right?
Right.
So let's say, hypothetically, your IUL has a 0% floor and a 10% cap.
Okay.
In the years where the market goes up 10%, your IUL would capture that gain up to that cap.
Right.
But in the years where the market drops 10%, your account wouldn't lose any value because of that 0% floor.
Right.
So it's kind of like you're riding the waves of the market, but
Yeah.
you're only taking the upward swells, so to speak.
Yeah, that's a good way to visualize it.
Okay, cool.
Right.
Now, on the surface, it might seem like those 10% gains and losses in the market would just kind of cancel each other out, right?
Right.
Resulting in a net return of 0 over those 10 years.
Yeah.
But that's not quite how it works, is it?
No, it's not. And that's a common misconception because it seems intuitive, right? Up 10, down 10 back where you started.
Yeah.
But the math doesn't actually work out that way.
And the author actually says that this scenario leads to a loss.
Exactly. Let's break down the math a bit to make it clearer. Imagine you start with, say, $100. A 10% loss brings you down to $90.
Okay.
Now, to get back to your original $100, you need more than just a 10% gain on that $90. You actually need about an 11.1% gain.
Oh, I see.
So even though the average return in this scenario might look like it's 0% because you had equal ups and downs,
Yeah.
you'd actually end up with slightly less than what you started with.
So even though the market seems like it's just bouncing back and forth,
Right.
you're actually slowly losing ground over time.
Yeah, because each of those losses is cutting into a smaller and smaller amount.
Got it. So this is where the author's suggesting that IUL, with its built-in protection from those losses, can actually thrive in this kind of environment. In their hypothetical scenario, the IUL doesn't actually suffer the losses that kind of drag down traditional investments.
Right.
It captures those gains when the market's up, but then it stays stable when the market dips, thanks to that floor.
Exactly. And the author claims this leads to a really significant difference in the outcome
Compared to a traditional investment.
compared to a traditional investment in this kind of market.
So let's talk about that difference. How does the IUL actually perform in their hypothetical scenario?
Well, that's something we'll explore in the next part of our deep dive.
So we've laid the groundwork, understanding how IUL differs from traditional investments with its indexing, floors, and caps. And we've set the scene with this idea of a choppy market, where the market alternates between 10% gains and losses. Now let's see how IUL actually performs in this scenario, according to the author.
Yeah, so the author claims that while a traditional investment would lose value during those 10% down years, an IUL policy with its floor wouldn't. It would essentially remain flat, just hitting pause until the market recovered. And then when the market goes back up, the IUL captures that gain up to its cap and locks it in.
So it keeps growing from each year's high point, right, without ever suffering those losses that drag down traditional investments.
Right. And this is where the author suggests that the power of compounding really comes into play with IUL.
Yeah.
Because you're avoiding those dips and building on a higher base each time, your potential for growth becomes much greater over the long term.
Okay, so the book actually runs the numbers on this hypothetical scenario, right?
Yes. They compare the performance of a traditional investment to an IUL policy over those 10 years of alternating gains and losses. And remember, with the traditional investment, if you start with $1,000, you would end up with just over $950, even though the market seemingly went nowhere.
Right. So what happens to that same $1,000 with IUL in this choppy market?
Well, according to the author's calculations, with IUL, that initial $1,000 investment grossed over $1,610 after 10 years.
Wow, that's a gain of over 60% in a market that didn't show any significant overall growth. That's a pretty big difference.
It is, and it really highlights how mitigating those losses can be just as important as, if not more important than, chasing those big gains, you know?
So it's not just about staying afloat during the rough times. It's about positioning yourself to really take advantage of the good times more effectively.
Exactly. The author presents this as a key advantage of IUL, particularly for those who prioritize that long-term growth and are maybe less concerned with those short-term market fluctuations.
But of course, like with any financial product, there are some things to consider before, jumping into IUL.
Absolutely. This hypothetical scenario doesn't include real-world fees or expenses, which can vary significantly between different IUL policies.
Right. And those fees can really eat into your returns. That's why it's always so important to get personalized advice from a financial professional. They can help you evaluate the specific costs associated with an IUL policy and determine if it aligns with your own individual goals and circumstances.
It's also important to remember that this is just one hypothetical scenario. Market performance is rarely this predictable in the real world. There are countless factors that can influence how investments perform.
So while this example is helpful for illustrating, how IUL works, it's essential to look beyond this one scenario. We need to consider how IUL performs in other market conditions, right?
Definitely. And that's something we can explore in more detail in the next part of our deep dive. We'll look at the potential benefits and drawbacks of IUL in different market environments and how it can fit into a diversified financial strategy.
Okay, so we've looked at how IUL might perform in that hypothetical choppy market the author lays out and talked about some real-world factors like fees that can eat into returns. But let's zoom out a little. How does IUL actually fit into a bigger financial picture?
I think it's important to start by recognizing that IUL isn't an all-or-nothing proposition. It's not about replacing all your other investments. It's about finding that right mix of assets that align with, your individual goals,
Right.
risk tolerance, all that.
So not putting all your eggs in one basket.
Exactly. Diversification, key to a sound financial strategy. And IUL, with its unique characteristics, can play a specific role within a diversified portfolio.
What kind of role? What are some situations where IUL might actually make sense?
One area where IUL can really shine is providing a level of stability and protection in a portfolio that might otherwise be heavily exposed to market volatility. Let's say, for example, you have a large portion of your investments in stocks or other assets that are, really tied to market performance. Adding some IUL to the mix could help cushion against potential losses during those downturns while still allowing for growth.
So it's like a buffer against the ups and downs.
Yeah, that's a good way to think about it. And this can be really appealing to investors who are maybe approaching retirement or are already in retirement, those who really need to protect their nest egg.
That makes sense. Are there any other situations where IUL might be a good fit?
Another potential use for IUL is as a part of a long-term saving strategy. Because of its potential for tax-deferred growth, it can be an attractive option for people looking to, build wealth over time. The cash value component of an IUL policy grows tax-deferred, so you don't pay taxes on those gains until you actually withdraw the money.
So it's kind of like a tax advantage savings account,
Yeah.
but with that added benefit of the death benefit component.
Right, exactly. And that death benefit can provide an additional layer of financial security for your loved ones, if something unexpected happens.
But it's important to remember that accessing that cash value through withdrawals or loans can have tax consequences.
Oh, absolutely. And it could even impact the death benefit. That's why it's so important to really understand the terms and conditions of any IUL policy before you sign on the dotted line.
Right. And there's also those potential surrender charges if you withdraw money from the policy early. This is where working with a qualified financial advisor is so important, right?
Couldn't agree more. A financial advisor can help you navigate all the complexities of IUL, assess your needs, make sure it aligns with your overall plan.
Yeah, they can help you compare different IUL policies too.
Right. Find one that offers the best combination of features, at the best cost for your situation.
So IUL sounds like it can be a valuable tool for certain investors. But it's not a one-size-fits-all solution, is it?
Definitely not. That's why it's so important to do your research, ask questions, and get some good advice before making any decisions. I think the best way to determine if IUL is right for you is to have a conversation with a financial advisor who understands your circumstances, someone who can give you personalized advice.
So as we wrap up this deep dive into IUL, I hope you've gotten a better understanding of how it works, the potential benefits, and the things to watch out for. It all comes down to being informed. Knowledge is power, especially when it comes to your finances.
And as always, we encourage you to keep learning, exploring, and engaging with the world of finance. Ask questions, challenge assumptions, and seek out different perspectives. The more you know, the better decisions you can make.
Well said. Until next time, happy diving.